Welcome back, RMJ. Ready to pick up where we left off with this depreciation stuff? It's a classic accounting vibe. We were just about to dive into your notes on how to handle that machine purchase from 2023. Do you want to walk through the formula first or go straight to the journal entries? All right, let's break this down. First, we need to look at the formula for straight line depreciation. This is our core formula. Now, let's pull the numbers right from your problem notes. We've got the cost of $60,000. That's what we paid on day one. Then we have the residual value of $10,000. Think of this as the scrap value, or what we expect it to be worth after we're done with it. And finally, the useful life of 4 years. That's how long we plan to use the machine. When we plug those in, we subtract the residual value from the cost first. That gives us the total amount we're going to depreciate over time. So 50,000 divided by 4 gives us $12,500 every single year. Does that calculation make sense before we look at the schedule? Perfect. Now, let's see how this plays out over time with a depreciation schedule. At the end of the first year, December 31st, 2023, we record our first chunk of depreciation. The carrying amount is just the cost minus all the depreciation we've taken so far. So 60,000 minus 12,500 equals 47,500. By the end of year 2, we've taken another 12,500. So 12,500 times 2 is 25,000 in accumulated depreciation. Check this out. By the end of year 4, the carrying amount is exactly $10,000. That matches our residual value perfectly.
Huh?
That's how you know you did it right. See how the accumulated depreciation just keeps growing by 12,500 each year? Boom. Now for the actual accounting magic. The journal entry to record this every year. We debit depreciation expense because expenses go up on the left. This shows the cost of using the machine this year. Then we credit accumulated depreciation. This is a contra asset account. It sits right under the asset and pulls its value down over time. One common mistake is trying to credit the machine account directly. We don't do that. We use the accumulated depreciation account so we can always see the original cost on the books. Does it make sense why we use a separate account for the accumulated total instead of just lowering the machine's cost directly? No worries. Think of it like a receipt and a wear and tear log. If we just erased the value from the machine account every year, we'd forget what we originally paid for it. By keeping them separate, anyone looking at your books can see, okay, they bought a $60,000 machine and they've used up 12,500 of it so far. It's like keeping the original price tag on a pair of shoes, but having a separate note saying how many miles you've walked in them. Does that help it click? Boom, you've got it. Keeping those numbers separate makes the history of the asset crystal clear. Since we've walked through the whole process from your notes, here's a quick summary of the big points. And I've got those flashcards right there for you to keep this fresh in your head. Do you feel solid on this example? Or do you want to try a quick practice problem to make sure you're a pro? In an exam, they love to hide these numbers in a wall of text. Here is how you hunt them down like a pro. The biggest hint for straight line specifically is when they say the asset provides equal benefits each year, or they don't mention a specific usage rate like miles or hours. If you see a date like July 1st, your $60,000 machine would only have $6,250 of depreciation for that first year. Want me to show you how to calculate a partial year, just in case they throw that curveball at you? All right, let's say instead of January, you bought that machine on July 1st, 2023. Since you only owned it for 6 months of that first year, you can't take the full $12,500. You take your annual amount and multiply it by the fraction of the year you actually used it. So for that first year, you only record $6,250. Simple as that. Does it make sense why we'd only take half the amount if we only had the machine for half the year? Oh, you definitely still need to count the carrying amount. It just changes how the math looks at the end of that first year. See? We still do cost minus accumulated depreciation. Since we only took half a year's worth of wear and tear, the machine's book value is higher at the end of the first year. Then, in the next year, 2024, you'd go back to taking the full $12,500 because you owned it for all 12 months. Does that clear it up? The rule for carrying amount never changes. Only the amount of depreciation you subtract might change.